How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic I want to discuss with you guys in full detail joint and survivor annuities and fully explain the pros and cons of each. Now, an individual is typically looking towards a joint and survivor payout, whether that's through a pension option where they might be given like an annuity pension option, or more on the private side where you could leverage existing retirement assets, roll them over into specifically designed annuity contracts that will provide lifetime income for both you and your spouse. Meaning that when income is going to you guys, when one spouse passes away, the money will still remain until the second spouse passes away. So it's just some really good ways on how somebody could leverage their age and leverage their longevity, basically their mortality rate, the chance of them and their spouse passing away, to their benefit. One of the first things that I want to discuss is pension income. As many times individuals have something known as a joint survivor option, a joint income on their pension side that they could maximize out their income goal and their death benefit goal. And there's a specific strategy that person could use if they're utilizing a pension income, where they might be able to, it might be more favorable for them to take the single life income and then purchase something known as a death benefit policy, a permanent death benefit life insurance policy, to make sure that the second spouse is covered if that spouse that has the single income basically passes away prematurely. And what I mean by that is, let's say if someone's given a pension option, they have a single option or they have a joint option. And let's say the single option gives them $50,000 per year of guaranteed annual income, and the joint option says, okay, it's going to cover both them and their spouse, but that's going to be for $35,000 of joint income. So when the one person passes away, the spouse could then, receive the $35,000. Well, dependent upon the insurability of that individual that's getting the offering, they might be able to say, okay, I'm going to actually take the single life only option and then purchase a life insurance policy for, let's say, $10,000. And maybe that life insurance policy is going to purchase another $600,000 of tax-free income of a tax-free death benefit to the joint recipient. So what would happen over there is, if it costs $10,000 to purchase that life insurance policy, but they're getting $50,000, obviously they're going to be receiving $40,000 as a couple while these two are living. Right after, so that you're netting a $5,000 extra profit there. And then whenever that person passes away, well, now you have the remaining spouse that has a lump sum of $600,000 that they could utilize those monies in a tax-free, and basically it's money because it's life insurance. It will go to them 100% tax-free, and now they could leverage that into their own personally designed pension plan through the form of like type of annuity contract. So that's the death benefit goals that I'm talking about. So there's ways on how you could leverage your actual pension plan when you're looking for joint and survivor annuity payouts. But it really works on a case by case basis. If that person's not insurable, if he has some sort of ailments, he or she has some sort of ailments, then that's not going to work. It's really going to blow up in your face. It's not a way to do that. But in many circumstances, you could actually leverage your chips properly to make sure that you're netting out that plus $5,000. Now, in that scenario, let's say they're purchasing the life insurance policy. This person's getting $40,000, and then all of a sudden the spouse passes away before them. Well, then they'll just cancel the life insurance policy, and then they would have that increase of back up to $50,000. So you kind of play in two different avenues. So that's the death benefit goal. Now the income goal, this is where I like to have a lot of fun with it, and we get into the conversation of cash flows, and we try to avoid the negatives, avoid the problems with these sorts of income goals. So one of the things that very popular annuities right now that we actually like to specialize in are hybrid annuities, and this has been gaining more and more ground after 2008, after they were first established. And what happens is an individual is able to leverage their retirement accounts, their basically their retirement savings, whether that's in qualified retirement plans such as 401k or an IRA, or they have this money in cash from the sale of a home, the sale of a business. Well, that could be set up in a non-qualified annuity. And what happens is, let's say if somebody has, let's say $100,000 is an easy example, and you have a couple, let's say you have, a male age 61 and a female age 60, and they want to use this $100,000, depending upon where these monies are coming from, that's how you have to establish that sort of annuity contract. So if it's coming from qualified funds, it would be a rollover or transfer into a qualified IRA annuity contract with a specific lifetime income rider. If it's non-qualified monies, it would just be a non-qualified annuity contract with a lifetime income rider. But essentially what happens is, let's say that you have this couple, they have $100,000 and they want to retire by the time that the youngest spouse is age 65. Well, this individual could say, okay, well, I'm just going to throw it on a single life only option, play that same game with that death benefit goal, which I wouldn't recommend. When you go and you guys could have it in both of your names on more on the private side where you have assets and you're leveraging those assets to receive retirement incomes, you could set up on a joint income rider. So what happens is this $100,000, it would be a simple concept of just saying, okay, I have $100,000. Which carrier, which contract is in my particular area is going to give us the highest joint life income option at age 65? So the problem that happens with these is individuals would go sit down in a seminar and they would say, okay, well, this advisor was pitching this great annuity, company XYZ annuity. It's, has this income rider, all these different benefits. At the end of the day, annuity contracts, you have about 1,000 or plus different offerings per state. So the fact that if you're sitting at a seminar and that person is pitching one annuity, 99% of the time, it's not going to be the absolute best annuity for your specific situation. And that's something I try to hit home with any single time that somebody watches my educational videos, whether they listen to my radio show.